Hello and welcome to the Material Advantage podcast. We're covering everything that business leaders need to know to stay ahead of the materials and chemicals transition. I'm Rachel Mile.
And I'm Dan Noakes.
And we are releasing new episodes every month, so subscribe for the latest content. So this episode is all about investment. What has gone wrong? Despite billions being pumped into material science and innovation, what's gone right and where the next growth opportunities might come from, also looking at the models and the approaches so far. And with that in mind, Dan, my opening question to you is, what has been the approach when it's come to investing in novel materials and chemicals?
Rachel, this is an interesting one for today. Biomaterials has been seen as a major growth area, especially from 2018. To be a material scientist has been to be in high demand. There have been plenty of new entrants into the market, introducing technologies that are historic, and they're reintroducing them with a new twist, or there are new technology entrants that are completely new, and there's an advanced science that has been created because of new techniques for manufacturing or new techniques in analysis or even simulation. So in silico computer generated simulation that has allowed us to make new materials. And I think that is the thing that started to attract almost like a gold rush into the sector, and is slightly on the decline as things are becoming more sensible. So I think the answer to the question is, it's on a scale between investing in the thrilling opportunities that can be a bit of a gamble, all the way down to the boring opportunities that can be probably more credible, but maybe don't attract some of the headlines that the more thrilling ones do.
I was in Brussels last week for a couple of events, the Future Fabrics Expo and also the Textiles Recycling Expo. And one of the questions I came away with in my head is do you need to be from an industry to have an impact in an industry? And there's been whispers of tourist VCs in the novel technology space, especially climate tech, materials, food tech, ag tech, chemicals, who maybe don't know the technology as well as they should do. I don't know, in your opinion, if that even matters, or if it's really just, again, going back to the basics of having a business and investing in a business and having the market demand to scale that business. What's your view on that?
Yeah, good question. So more money into the sector is never a bad thing. It's a big barrier for scaling technologies, because inventing and commercializing new materials can be heavily resource intensive, people intensive, and the sort of technical equipment used to make scientific breakthroughs are in themselves specialist. So to manufacture, having access to these things is not an easy thing. It's expensive. So more money into the sector is very much welcome, and all businesses are run on the fuel of money. It's just as simple as that. It is the fuel in the tank. The problem is that money rarely makes it to the right technology or the right business that's commercializing that technology. There is almost like a chasm between new money coming in and finding something that is credible but yet thrilling. There are some amazing new technologies out there that have the ability to launch and be disruptive and be more sustainable, more circular, improve lives within society, but yet they're very rarely getting access to the new money coming in. So I would question how the investment sector and how the technology sector can be brought together more efficiently and more effectively. But then I'd also question the instincts of incoming investors might be very capable in other sectors, but when you come into this sector, it is so scientific and engineering heavy that then there's another layer of understanding that they need to prevent them from putting money into the wrong area, because it is very easy to get attracted by some headline figures and not really see the underpinning science that makes a technology robust. And you need that for longevity. For a technology to break through, it needs to be robust. It has to be based on significant underpinning science.
I have started thinking, is it really CVCs, corporate venture capital arms within industry, that are going to be the funds and the people that unlock the potential of these technologies. They have a real need. They know their industries, they know their supply chains. They can really work closely with companies to embed them within it, to learn, to scale, and to address any concerns. That's one question. And then the second one to you is, do startups even need investment in the first place? There's an argument that if you're building something that's genuinely solving a problem, is better, higher performing, cheaper, etc., can you grow your business on revenue alone?
I saw something recently that said bootstrapping your business versus bringing in venture capitalist investment. On exit, you could achieve almost 2.5 times the value back to the founder. So that's more attractive, bootstrapping. But then you have to see that there is someone, a founder behind that is taking maybe twice, 3 times as long, and they're having to make sure that they can finance themselves over a long period of time in some very challenging market conditions. And quite often, if you can't put food on the table, you're not going to be able to deliver on a daily basis for the business. So there is strong argument for bringing money into a business so founders can feel comfortable that they have the resources to be able to do the thing, to deliver. But with VC money comes a ticking clock, and there becomes an impatience in terms of how quickly a business returns value to that investment. And sometimes bootstrapping, it affords the founder the opportunity to take their time to work on the underpinning science and to make sure that any money or expectation comes in, that technology is ready for the marketplace. Because it doesn't matter how much money is brought into a business, if that technology isn't made robust enough, then the technology will fail. So either you're looking at pivoting the business to something else that you found on the way, or it literally goes bust. So it's understanding what's seen as credible, and the timing of investment is really important, I think.
It's one of the reasons I invited Tom from Big Idea Ventures onto the podcast, who couldn't come today, but we'll have him on later this year, because they do things differently. They're very well known within food and ag tech, launched a fund about 5 years ago that incorporated material science as well, and source IP from universities that has the broadest potential and appeal for commercialization. And then they own their own companies as opposed to scouting for existing startups to invest in. And then they do 3 rounds of investment to get them past that famous valley of death and appoint the right senior teams. And then once they're commercialized and scaled up, off they go into the market. But the timelines of traditional VCs versus the reality of scaling a hard tech business seem very out of whack. And the expectations are quite mismatched. And it seems like people are wising up to that now. Hard tech is not software. The exit expectations and timelines are so different. But are you seeing that awareness? Are you seeing that shift? Are you hearing about people and businesses investing differently now?
I see big successes where there are investors who have previously run technology businesses, and they're a lot more aware of the challenges within a technology business, and especially biomaterials, because feedstock into biomaterials can be variable, it can be seasonal, there can be challenges around unknown contaminants. So there's the robustness of the materials going into the products. There's the manufacture of the products, the processes themselves, whether it's microbial processes or whether it's advanced thermal processes. There's another level of complexity there. So you've got the variability of the feedstocks, you've got the complexity in the bioprocesses themselves, and then you're trying to hit a technical specification of the products. So there's almost like 3 levels of difficulty to overcome before you could put a product on the market at a margin, at a price point that starts to make significant monies and therefore attracts that level of VC funding. I think if those that have come out of the technology space, science and engineering, they see that, and actually the journey is the thing that they enjoy the most, almost, but with the added outcome that there is a pot of gold at the end. There'd be more tolerance there. I think you talked about investor tourism. If you come from other sectors where you see boom and bust sectors, there's an opportunity for quick wins. And we're looking at AI, we look at hydrogen, We even saw it in the internet with the dot-com bubble at one point. Investors are quick in, but also want to come quick out. That's not this sort of game. I mean, everything is materials. The whole built environment around us is materials. And so the impact is huge. And so you do it for a different reason. And those impact investors that come into this sector are actually wanting to see changes for future generations. And for that reason, they're willing to take more time. They're possibly not so hamstrung on big returns. But you do ask the question, what are the comparisons between the VC community and the impact investment community? Because they are different, they're meant to be different. And the choice in the investors that you take at the very start as a startup business, how much of that does go on to impact your longer term success?
And this is why I mentioned earlier about CVCs, because I feel like they have serious skin in the game. This is their industry, this is their business. I'm definitely seeing a difference between family-owned private businesses having a much longer-term view about what kind of business they want in the future, but also, is their business going to be around in the future? Have they got something to pass down to their employees and their family members, versus publicly listed companies? Especially at the moment, all of the emphasis is on short-term cost cutting and P&L. So I do look to them a lot in terms of trends, in terms of commitment and that longer term perspective. Techno Apex is an interesting one. Plastic Compounder in the US, they launched a CVC a year or so ago, so hoping to get them on here as well and talk about that, and again put their money where their mouth is and shape the future technologies for their own particular vertical. I'm just going to read out a stat as well about investment in biomaterials. So biomaterials funding peaked at 1.7 billion in 2022, soared to 583 million in 2024, and was recovering towards roughly 1.5 billion for 2025. You know, we were talking off camera about NFW and MicroWorks and others seen as pioneers really in this space, and whether that's just part and parcel of scaling novel technologies, or if there's any learnings from those businesses and those journeys that others can take from it. And what are the watch outs for brands and buyers? You know, there's so many angles to those stories. The market demand dwindling, the investment rush, the business model that was chosen. Is there one reason, or are there many? Multifaceted. There probably isn't one answer.
Well, I wish I saw some of this money. Certainly, I've seen maybe 50 to 100 companies come through that deserve that sort of money in the past decade that I've been working in innovation technology scale up, whether it's in the biotech space or the biomaterial space. I myself would have been happy to get some of that. I mean, that's a world-changing amount. And certainly the majority of businesses wouldn't need anywhere near that amount. So you do wonder where it's gone. And why haven't we seen more technologies reach commercialization, especially in the UK? We've had some real breakthrough technologies that are disruptive and they can displace fossil-based plastics. A few big names, Nopla, obviously, has attracted significant funding. Exemplar, Plantsy, they're all moving on to capital investment for the physical manufacturing of what is a fairly challenging feedstock to turn into finished packaging products. Yet there are hundreds more that wouldn't get close to those sorts of monies. And maybe it's a communication to the investment community that needs to happen. Certainly, the concerns I hear is an investor will spend 10 seconds on the first page of your pitch deck because they're seeing so many pitches every day that they're literally scanning through and they're looking for standout graphicals such as a hockey stick revenue projection. And if they don't see it, they skip on. And there's the concern that there are many technologies just fall through the cracks. Then there's the concern about timelines and return on investment. You hear what I would determine as high street style VC. They'll want a 3x return within 3 years. Or does that look like a 10 times return within 5 to 10 years? These are challenging for small startup businesses because we know that technology readiness level can be anything from literally having that idea at TRL 1 all the way to commercialization at TRL 9. It can take between 15 and 20 years. So where's the longevity that's going to allow that return on investment to meet the needs of the investors? So how they communicate that would be really helpful. I've also heard that generally they're looking for the unicorn. Do we need something that's actually going to have impact on the world and longevity, or are we really looking at unicorns here? And by that, they mean a 1 billion revenue, maybe within 10 to 20 years. And they do that because they expect a 1 in 25 success rate. So if they invest in 25 companies, they expect one of them to go on to generate big monies to pay for the other failures. I mean, you're almost thinking, could some of this money be managed better? Because if there was a slower approach with more technology due diligence and almost like a societal nod to what is needed rather than what is seen as attractive for investment communities, then maybe we could use the money better. We wouldn't have so many losses in the system. And then that 1.5 billion that you said there, that's market making, that could build feedstock supply chains, that could deploy technologies across every city in the country. It's significant enough
Mm.
that it would shift the game considerably.
And it still comes back to the question of what type of investment are we talking about? Because a lot of this conversation to date has been about VCs and their particular expectations and objectives. But governments are putting some serious money behind materials innovators. The Dutch government put a lot of money into Reju's plant to be built in the Netherlands. I talked a little bit about Traceless last time in Germany. I met a company last week at the fairs that is rebuilding a textile manufacturing supply chain in France with serious backing from France 2030. Circulose, I'm just checking the facts, filed for bankruptcy in 2024, was acquired by a Swedish investment firm in June 2024 and then relaunched and rebranded as Circulose. And that has some serious weight behind it. Their CEO is I think it's McKinsey, one of the big consultancies, so very business and commercially oriented. And the ex-CEO of H&M is on the board and really pushing that through as well. I come back to that point that where there is a will, there is a way. Is VC money the right money for long-term hard tech projects when it comes to ultimately building factories and building facilities? And especially when you start tying in some of these technologies to national security, like metals and minerals, should that sit with VCs and a particular type of investors?
Oh, that's a big one. RenewCell is my go-to case study for circular economy and scaling up supply chains. So I mean, it's not just scaling up technologies and processes, the supply chain has to be ready. And in that instance, the technology was robust, as I understand. The VCs backed it and they did their job. They came to the table and they did what they needed. I think in that instant, when the plant was turned on and they were manufacturing products, I think the challenge may have been around a premium price for the product coming out the back end of the plant. I mean, this is recovering of waste fibers and reprocessing it to go back into the textile market. If that product's not being taken up by the market, by retail, then it will never succeed. And so you have to have your producers and your retail locked into agreements that if you build it and you produce it and you hit price point agreed and technical specification, then it gets bought. And it's not a case that retail and brands will suddenly switch back to, well, virgin is cheaper, or there's a crisis in the Middle East, or it doesn't matter what it is. The technology has been scaled. People have spent their lives to develop these things. The VCs have backed it. And I think that was about £200 million investment. Then the supply chain has to pick up the rest because it will take a long time to embed those sorts of technologies into supply chains. But once we achieve it, we've got off the drug or the pill, which is fossil virgin materials. So there has to be longevity from the supply chain as much as there has to be longevity from the VC community. And I think this comes back to what is your serviceable, obtainable market. So for your TAM, SAM and SOMs, it's that bottom-up approach for selling product once you've built the thing and you're manufacturing the thing. Who's going to buy it? How credible are they? Have they got deep enough pockets to overcome any premiums that are required in the manufacturing? Because it could be higher energy costs, it could be higher labor costs, it could be higher material feedstock costs. But clearly it's the right thing to be doing. And over time, those challenges and costs will address themselves. But at the front end, it may be that you need some financial robustness supported by the supply chain. And for me, the margins are in the brands and the retail, because manufacturing is very tight margins. And so if the money's being made at the consumer end, then that's where the support needs to come from.
There's an argument the money isn't being made at the consumer end because of everything going on with, like you said, materials costs and energy and a general decrease in spending at the moment. Whilst you were talking, I was thinking about the simple truth of timing in all of this, because actually textile recycling or just any kind of waste to value is having a bit of a moment in many different industries and with many different feedstocks. Could just simply be a case of right business, right technology, wrong time. You've talked about brands and buyers as well, and it was something I wanted to talk about, which is what is their role in all of this? Because I hear it from all sides of the table. I've had brands and retailers who 10 years ago invested in compostable plastic bags, for example, that disintegrated before they even made it to the shop floor, and they just would not touch any technologies or alternatives after that, with fair reason. I've heard big brands as well say, we are not investors. We buy products from suppliers. Come to us when it's ready. Again, I totally understand that. I do see the opportunity in getting in early with new technologies because you can shape it and avoid the premium pricing later. But I do understand the role that all of these businesses play. And then again, it comes back to who shoulders the risk, who reaps the rewards, and at what point do these different stakeholders come in, and what is a fair ask of them?
Well, the risk is always the environmental risk, and it has to be seen that way. The risk is local authorities or local governments having to pick up the cost of waste collection, waste disposal, or some sort of processing. And the risk is we're running out of landfills in the UK. We're over leveraged on incineration across Europe. Other places such as India, are they going to follow the model of landfill incineration, or are we going to help them to do something better if we're going to scale populations, because they're on a meteoric rise? So in Europe, we have extended producer responsibility that's come through from the European Commission in various guises and directives. We have plastic packaging, textiles coming free. I think that's now live, EPR for textiles. There will be others. And the reason being is currently local authority or local governments are paying for the cost of disposal of consumer goods, fast moving consumer goods. And it will continue that way until retail and the producers take responsibility for the products that they manufacture. So as soon as you give retail and producers responsibility, that's the brands, then they start to look at how they've designed their product. So we have eco-design for sustainable products regulations come through in Europe, and that's forcing the producers, the manufacturers, to really think about the materials they're using in manufacture, to think about whether they're designed for recycling. Can you disassemble these things easily enough? And the materials after, is there recycling processes at scale that they can go into that means those materials go back into the marketplace as something else or back into a new original product instead of getting landfill and incinerated? So the role of the producer is unquestionable. It's just the question is, at what point will the producer be required to take responsibility? And that's coming through policy and legislation. If they don't, then they have to fund or pay for the collection and recycling of those end-of-life products. And in doing so, effectively, they'll have an additional line item on the bottom of their P&L that says end-of-life costs. So it makes sense for them to design more sustainable products using more sustainable materials that they know that is either recyclable or compostable at end of life. And for that reason, they need those technologies to scale. And for that reason, they need to support manufacturing, innovation, and the waste sector to bring them through. And one way they do that is by supporting offtake agreements. So they agree to buy the products once they're manufactured. And they may even use pre-purchase agreements. They might put, and I've seen this where this has happened successfully, where they put significant money in to a business or technology up front, years in advance of buying all the product that comes out over the next coming years. So effectively, they might put in a few million up front, but that few million is paying for every product that comes out of a manufacturing process for the next, say, 3 years.
In my mind, it's not just a company should do X because it's the right thing to do. I'm just being really blunt. These are businesses. They have their own set of goals and objectives. A business's goal is to grow. How does that fit with the situations we find ourselves, especially in Europe? We've just had a mega heat wave, and I think we're about to have another one. So, of course, that underpins a lot of what's going on in society and a lot of policy making, but it will be a tension that we're living with. I actually, when we decided to do this podcast, this episode about investment, I did put the word out to my mailing list and to my network and asked for people to put in questions for ourselves and for Tom as well. A sustainability leader, a brand in Australia, asked about this tension: profit or progress. A lot of material suppliers run on a purist mindset, which means that they will never or potentially never be able to reach profitability or long-term market presence. And it's interesting that she pointed that out, because a product still has to do something. It still has to meet a need, create desire or aspiration, whatever it is that designer has decided or that company has decided. Is that a tension that we are going to just need to accept and move on from, or is there a realistic answer?
I think the key word you used there, Rachel, was need, because I think a lot of consumer products, fast-moving goods on the market, are not needed. Look at consumerism around Christmas. The amount of items that get bought at Christmas that are in the bin post-Christmas and are off straight to landfill or incineration. So something that's needed is kept. It's generally not single use, and it serves a use or purpose in people's lives. That's different to something that can be solved to make a product to fit a business need. This is where policy and legislation comes in, because it has the opportunity to shape or scope markets so that there are less products being placed on the market that are effectively just wasting resources. There's some silly things that are manufactured because they can be, and because they can be sold at a really cheap rate and in huge volumes. So I would argue that we start to use better materials that are more sustainable for our planet. We put more money into manufacturing them to produce better products, but those products last longer, so increase the use phase for circular economy, but are kinder to the environment if they escape into the environment, or are recyclable at end of life. Now, I don't think that has to prevent profitability. I think that there is definitely room for consumers to be attracted to products that fit the market's sustainable needs and do a job that they needed from a daily basis. So there is definitely opportunity for margin in these sectors, but it's being aware and cognizant that maybe we've got too used to consumerism being cheap and mass manufacture. Things like injection molding, thermoforming has left us complacent, thinking everything can be cheap. I think that's going because oil is a finite resource, geopolitical conflicts, various reasons why feedstocks are becoming more challenging to get hold of and turn it into products. I think it's going to change anyway. So the opportunity is to switch onto new feedstocks to be able to counteract some of those increased costs selling to the consumer, and to make something that's purposeful in the first place and make it last longer. But at its end of life, make sure it fits the need of extended producer responsibility, where you can collect it, recover it, disassemble it, and put it back into the marketplace as something else.
The drivers will be economic. We've touched on a few things previously, but you've said about geopolitical tensions and the fact that resources, water, metals, minerals, oil, gas, really, they are in the hands of a very small number of countries controlling that flow and controlling that marketplace. Off the back of the podcast, I did see that the US government has put investment into circular mining, so using mining tails, for example, to extract metals and minerals as opposed to getting them straight from the ground. Like you said, regulatory pressures, the stick. We are planning to have the head of sustainability and public affairs, Adam Reed from Suez, on this podcast in the future, and he's been really instrumental, as has the waste management industry, in shaping and implementing EPR. So it'd be interesting to speak to him about that. When there was one other thing I was thinking about, just the cost of materials. And what always scares me is how little people actually know about their own supply chain. But, when these legislations and regulations have come in, these companies don't know how to respond. They don't know what's in their products, because there's so many different layers of manufacturing and processing, and these products get sent all over the world for various finishes, etc. So yes, the real driver for businesses will be economic, but it is very much tied to that geopolitical and environmental elements as well. Actually, that was the last thing I was going to say. Increasingly, the risk of being sued. And it's a big thing in the US, obviously, societally, but California, the governor's taking Lululemon to task over PFAS, for example. There's an argument that there's a bit of showboating, a bit of PR, but there will be communities as well putting serious pressure on businesses and industries that have factories that are polluting waterways and polluting land. So I wonder if that will come into play a bit more as well, like community or government legal challenges around some of the more polluting materials and chemicals and processing technologies. I'm conscious of time. Is there anything else you wanted to talk about, Dan?
Well, just briefly, I mean, you were about to touch on class action there. It's keeping the lawyers busy, but we've also talked a lot about doing the right thing. And I think this is where the role of governments and local governments come in. If you want regeneration of local communities, things like bringing back manufacturing is no bad thing. It's jobs, it's inward investment, it's wealth creation, and it's producing the sort of products that a society needs, and maybe from the waste materials that are produced by that society. So if you put the manufacturing near where the people are, you've got a constant stream of feedstock from wastes. So there's a role there for governments and local governments to help with innovation funding. And I think that it's often hard to point the finger at the value chains that they have to foot the bill for this, but they're on an 18-month cycle of profit generating, and it's not easy for them. So the support that governments can bring from public funding and taxpayers' money, it's significant, it's important. It's de-risking the investment for supply chains and for industry sectors so that we can do better things whilst creating the jobs and without harming the environment, but yet remaining profitable.
You've perfectly articulated what I was saying earlier about who shoulders the risk and why. And you can see that a lot of innovators go straight for the brands and buyers at the end to create demand, but actually there's a whole gamut of people in the meantime that are needed to better that technology, to commercialize that technology, to scale the business itself, not just the technology, but the infrastructure and the human capital around it. There's one last thing, actually, that we can end on. A lot of people might not know this, but you yourself are an investor. And if you could change one thing about how buyers or investors approach materials innovation, perhaps one misconception you'd like to correct, what would it be?
How buyers or investors approach materials. It's the appreciation of the science and engineering that goes against these investments that are so important. There is no point investing in something and moving too quickly and forcing the science and engineering to do things it's not ready yet to do. If something is not robust before it's deployed for scale up, for commercialization, then it's never going to work. So you need to give the time for the technology to reach a robustness where it's repeatable and you're not going to get batch failures. Because if you build something for a couple 100 million at scale and every third batch fails, you've not got a business, but you've invested 100 million. So give a lot of time, energy and resource at the smaller scales, because at the smaller scales is when you can make the most amount of changes and you can iron out a lot of those mistakes or a lot of those pitfalls that arise in technology scale up and development. So don't jump to big scales on day one. Make sure that there is a robust design of experiment at each scale of scale up for a technology, and also give that same principle to the business, because businesses have to go through scale up as well. And certainly in the early stages of a business and technology, public funding's really helpful and you might get grant funding to do that. But I do hear increasingly this second valley of death, which is a technology is there at demo scale or pilot a demo and it needs to now get to the next phase, but it isn't yet selling products or generating, say, £1 million a year revenues. And therefore, certain investor communities aren't interested. So there's a big gap for those that are almost ready to get into commercialization and start making sales if they reach manufacturing, and those that have already made it, that are already producing £1 million a year in sales and therefore are highly investable and reduce risk. There's almost an investment gap needed for what some would call pump priming the markets, producing enough material or product that will satisfy the markets, that markets say, if you produce that to that specification, we'll take 100,000 tons, say, a year. I've heard that being called the second valley of death, and it's real, and I've seen it. And I wouldn't have seen it had I not gone into investing in technology scale up, as you've rightly pointed out. And I've been in technology innovation scale up for 10 years.
So what's the answer? I don't expect you to have the answer, but just out of interest, what is the answer? Because it keeps happening. I am assuming it's not unique to materials and chemicals, but it is particularly to hard tech, having to build facilities and factories. But what is the answer then? Because is this just something that's going to keep cropping up, and do we ever get past it?
So what's really helpful is things like pre-purchase agreements, which I mentioned earlier, where companies can afford to give a scale-up business or a technology business a couple of million to pre-purchase all their product that they produce over the next 3 years if they build a manufacturing plant. I think to overcome that second valley of death, and I was so surprised to find out this was the solution for a lot of businesses out there, and we're talking some highly credible businesses in the advanced materials space, where you'd think it would be easy to raise that sort of investment. And what I come to realize was this gap was plugged with crowdsourcing. So there was a match from private sector, match from maybe the innovation communities, the investment communities for startups, but it was supported with crowdfunding. And there are a number of crowdfunding platforms out there that are being used for anything from making a brand new guitar design all the way up to scaling advanced materials or biomaterials. And it really surprised me that you would need to go to a marketplace where you're talking to civilians, in effect, who are placing £5 investments into a product where you're expecting to invest millions. So you end up with a couple of hundred shareholders all putting in small quantities of money just to make that baseline amount that allows you to scale as a business.
Now you've said it, it makes a lot more sense. I just thought there was a bit of a trend and people were following others, but it makes a lot more sense now. I mean, it complicates things, but you have a lot more control, I guess, because they're very open about the fact you might not get your investment money back. There might not be a return, you might lose it. I have said this previously as well, materials innovation companies starting to market directly to consumers and bypass existing supply chains and producers. So I wonder if that's part of it as well. They're being forced, I guess, to do things differently, to think about things differently and to go direct to consumer. I was thinking as well, there's a lignin startup that asks a very pertinent question every time they get into conversations with a brand. When things go wrong, where does the buck stop? And it really forces the person on the other side of the table, the brand or the buyer or the supplier, whoever it might be, the investor, to acknowledge that things can go wrong, especially in this space, and to really think about what happens then, because pre-purchase agreements are all very well if they are honoured. And that is part of the problem that some of these contracts have been reneged on. It is that long-term commitment, long-term vision, and really committing to something and knowing what those potential pitfalls or those potential barriers are from the outset, and really thinking through actually how are we going to work together to overcome them.
I've had the misfortune of being in startups and businesses that have gone wrong, and the business has had to shut down, close. If it hasn't been rescued by a larger party, bought out, and you find yourself moving from one business to the other under TUPE in English law, and then effectively the businesses hit the wall. And it happens because it's high risk, especially if you're building CapEx. If you're building capital infrastructure and you're not manufacturing product and selling product, then you've got significant overheads to meet. And if you're not meeting it, then your runway's running out, burning far faster than if you were a small bootstrap business trying to work on small scale technology development. So it does go wrong. And when it does go wrong and companies are having to liquidate, then the IP becomes available. Assets can be bought up at cheap rates. Someone invariably comes in and swallows it and then decides what they're going to do with it. These things become attractive as distressed assets to banks because there's a reward in flipping distressed assets. But for a founder, if you've been working 15 years on a technology and the technology hits the wall, it's time lost that shows very little reward at the end of it. And it's a sad fact, but that timeline can be accelerated by the expectation of VCs and for the need to start achieving at scale. So there's a really fine balance that founders and investors have to play between themselves. But ultimately, we all want success stories. And that's where that tolerance for taking longer to get to market, and once you've got to market, supporting those new investments, new technologies, new products and processes to stick in the market and stick in supply chains, which is why when we talk about this, Rachel, I always advocate scaling the supply chain at the same time as scaling the technology, because if the technology is there and ready to commercialize, but the supply chain isn't ready for it, that technology is going to be burning cash and that business can't survive unless there's going to be a buyer.
Dan, thank you so much for joining me. It's always a pleasure to speak with you. This has been the Material Advantage podcast. We're covering everything that business leaders need to know to stay ahead of the materials and chemicals transition. We are releasing new episodes every month, so subscribe for the latest content.